My name is David Marsh. I'm the chairman of OMFIF, and it's a great pleasure to introduce three people who are going to be talking to us today about the future of productivity and growth in the major industrialized countries. Leading off is Jan Mischke, who is a partner at MGI, that's McKinsey Global Institute, who has produced an exhaustive study on this question, setting out four different scenarios for what might be happening in 8 key industries in 7 countries. That's the United States and 6 leading countries in Europe. So Jan is going to be speaking about his report, which I do encourage you to read. And then coming in after that, we'll have Gilbert Stet, who is the Deputy Director General at the Banque de France, looking after economics and finance, so looking at the whole world from the Banque de France perspective, and Catherine Nice, who's the Chief European Economist at PGIM, the big American financial services and asset management company. So welcome, all three of you. Jan, could you tell us in a few choice words, what does your report say about the return to productivity and growth after the pandemic? And is it optimistic or is it pessimistic?
Yeah, fortunately, it's actually there is some reason for at least cautious, if not more, optimism, with some disparity, I would say, on the regions, but we can get to that. So in a nutshell, we actually see a quite substantiated opportunity for a full percentage point acceleration in productivity growth, which is a big deal. Huh? So for the US, for instance, that would amount to $3,500 additional per capita income in just 5 years. And of course, it would accumulate to more as time stretches out further. Now, the reasons are on the one hand, of course, as everyone knows, stories of shifts online and further digitization have been well told, but it's much more than remote work and online channels. So companies have been automating at rapid pace, and they see that sustained. 75% of respondents to an executive survey we did say they're going to increase investment in automation and technology over the next 5 years. And it's in different speed. So a lot of companies have digitized processes in a few weeks rather than the typical year or 2 years. And again, in our survey, 75% say they're going to sustain and continue to raise the pace of decision-making, the agility of their organizations. And there's also more innovation going on. If you give you an example from the construction sector, industrialized techniques, moving a modular production off-site has been around for years or decades, but now finally companies are on the starting blocks to make it happen. There's just kind of a different perception to risk and to the boldness required in response to this crisis.
Just before we go over to Gilbert, could you just say in a few words, is there a big difference between the United States and Europe? Because you're surveying these 6 major countries in Europe. Surely Europe is in a different place compared with the United States. Is it, or what is the picture there?
Yeah, interestingly enough, as it regards the productivity acceleration opportunities and also the realities reading from our surveys and from the data, there's not much difference between Europe and the US. The acceleration is very similar. Where there is a big difference, and that actually matters, is on the demand side. So all this kind of supply side shifting out the curve will go to waste if we don't have demand strong enough to keep the entire economy growing. And that is solved for better or worse in the US for the next year or 2 at least. And in Europe, the jury is out.
So Gilbert, let's hear from you now. You've looked at this report. It's a remarkable piece of work, but there, of course, must be disparities between the different sectors, because Jan and his team have surveyed sectors ranging from automotive, to transport and logistics, retail, all pharma, everything is there. Where do you see the differences in different sectors, Gilbert? And also, do you also share this optimism that Europe and the United States are actually going to catch up at a broadly similar pace?
You know, we are still in the crisis, and this crisis is, we need some more years to get the final picture. But I totally agree with the big picture of the report. This crisis differs by a lot from previous ones in different ways. And previous ones were correction of unsustainable growth for instance, it was a case for the Great Recession, or were caused by huge supply shocks, oil shocks, for instance. And from that, they had a detrimental impact on productivity, both on level, in level and trends. But this current crisis differs totally. It comes from an exogenous shock, the COVID-19 pandemic, and it is not endogenous. And from lockdown and other administrative decisions, it accelerates by a lot the digitalization of advanced economies. Everyone can see this every day. Teleworking, for instance, teleworking generalization is an expression of that. And from that, it should contribute to help us to leave the previous period of productivity puzzle and to get at last the full benefit of the digital economic revolution. Now, of course, some factors we still have a detrimental productivity impact. For instance, factor misallocation amplified by low interest rates, or faster human capital obsolescence due to faster technology renewal. But the global effect should be positive, and on that I share completely the point of view of the report, and it could be long, large, as it was the case for previous technological revolution. So it's too soon, to make difference of the positive productivity impact in the medium term in one industry compared to another one. But I think that the big picture concerning productivity growth could be a positive impact, which is a total difference with previous crises.
Well, thank you. We look forward to seeing the report translated into French in due course, Yann, so it can get adequate circulation at the Banque de France and other places. Catherine, just going into these sectors, Yann has looked into 8 different sectors, which are quite dissimilar in lots of ways, as I mentioned, everything from pharma, banking, through to travel and logistics. Do you think, Catherine, there is a danger that some sectors will be preserved in their pre-COVID state because of this issue of low interest rates that Gilbert mentioned, this issue about zombie companies that we've heard a lot about? Is there a danger that could hold back productivity growth if we don't get the right kind of renewal taking place in some of these key sectors?
Potentially, that is a risk indeed, and a risk that is perhaps different between the two economic regions of the US and Europe. I mean, we tend to think of the US as being a much more dynamic, flexible economy, and Europe being more slow moving. I would caution against a bit of that, because Europe has made significant progress, particularly around product market competition over the last couple of decades. They've got very strong antitrust under Margrethe Vestager, for example. And that means that things like mobile phone tariffs and flights within Europe are a lot cheaper than they are in the US. But having said that, the way in which governments supported households and firms through this pandemic differed between the US and in Europe. And some of those differences in Europe, in my view, could potentially make this adapting to these accelerated trends that we've been talking about that much more difficult in Europe. I'm thinking here in particular around short-time working schemes and forbearance on European firms, including potentially lower productivity firms, all of which could delay the transition of capital and labor, the scarce resources in Europe towards these more high growth industries. So yes, it's a risk.
Is that a danger, Yann, from your point of view? You've surveyed 6 European countries, quite different in lots of ways. Britain, which is now outside the European Union, Sweden in the EU, but not in monetary union, and then the 4 big economies in economic and monetary union of Germany, France, Spain and Italy. Where do you see the differences in Europe? And also, what message are you giving to governments?
in terms of what particularly the large and leading firms are doing, it's not so dissimilar. Where there is a difference, this is what's happening to the longer tail of smaller firms. And just to give you some numbers on that front, in the US, in the crisis year last year, there have been 30% fewer bankruptcies than in the past. So all the kind of government support has actually led to less creative destruction. That is actually, the numbers are not dissimilar, minus 19% in Germany, minus 30% in Italy. But what is different is that in the US, actually new business formations are also up 24%. And the share of small firms in the economy is just about a third. If you look at Germany, new business formations have been flat. The share of small companies is about 45%. And in Italy, new business formations are down 17%, and the share of small firms is 2/3 of the economy. So I would expect not only some risk of divergence Europe versus the US, but also divergence within Europe.
Is this a real danger for Europe? Gilbert, you mentioned low interest rates just now. And the figures that Jan has just been telling us seems to indicate that the rate of renewal in Europe has been held back perhaps by extensive government support and very low interest rates, which some people in France, as well as in Germany, they're complaining about low interest rates because they say this prevents this Schumpeterian renewal. Now, of course, to paraphrase what Zhou Enlai is supposed to have said about the French Revolution, it may be too early to tell, but could you just put on your crystal ball, look into your crystal ball and tell us whether we will get this Schumpeterian renewal in Europe?
Yeah, you know, the first part of state reaction was, the first step was very well done in Europe and in France, I find, to preserve employment, to preserve good firms, not to for them to be in a bankruptcy situation. Just to give you one number, in France, you know, we had something as 1,000 bankruptcies per week before the COVID-19. Since the COVID-19, so since more than a year, for more than a year, we have, I would not say only, but we have 600 per week. The gap is 400 per week for 15, 16 months. So that's a huge difference. And now the challenge for policymakers is to leave the large support they have given to firms and to employees during the pandemic, the heat of the pandemic, and now to prepare the country to benefit from the largest recovery possible. You know, and that's a big challenge. Just to give you an information, in France, as in fact, you know, the European countries, firms are facing difficulties to hire people and to find employees for some jobs, which is surprising, even more in a country as France, where the unemployment rate is by a lot higher than in Germany, for example, or in North European countries. So the difficulty is real, and now the new step for policymakers is to leave the large support they've given, and not of course to push in bankruptcy good firms, but to let bad firms be in bankruptcy as they would have been without COVID-19.
Well, that is an amazing statistic, actually, Gilbert, about the number of bankruptcies having actually fallen. I mean, clearly it's good for the individuals concerned that is the case. But Catherine, it gives us the feeling that maybe the worst is still to come. And phasing out this huge amount of assistance and also deciding when to go back to fiscal and monetary normalization, that must be a huge task for policymakers. You used to work at the Bank of England, Catherine. You're now working for an American firm. Where do you see the differences between the United States and Europe in terms of when to go back to some kind of normality from a policymaking point of view?
So I think what we've learned is that there's nothing inherent in the COVID crisis that means it's inevitable that we will suffer long-term economic scarring. The US and China are good examples in that case. So that there's no reason why it should be different for Europe. That's very much my view. Stepping back, what we've seen is it really just comes down to good science and good policy. And here I would agree with Gilbert that in Europe, the policy around tackling this first acute phase of the crisis has been really quite positive. And it's remarkable in both the US and in Europe, we are well on track in terms of closing the gap of economic activity, bringing it back to where it was in 2019 Q4. So the question now becomes, can we move towards closing the gap in economic activity back towards its pre-crisis trend? And here I would agree with Jan. Things look more optimistic in the US, given the extraordinary demand stimulus there, than they do relative to Europe. But I think it's important to remember that this pre-crisis trend, both in Europe and the US, it should be stressed, was really not great. And so the question then becomes, can we use this crisis as a catalyst, not just to get to the pre-crisis trend, but actually to improve on it? And here, there are a number of ways potentially that could happen. So Jan has already talked about these accelerated trends around digital working and ways of working more generally. But I think there are other factors at play here as well. Firstly, around political momentum to really deal with long-standing barriers to productivity and economic growth more generally. In Europe, I'm thinking in particular around progress towards further integration. In the US, the focus has been really on active labor market policies to really support people back into employment. This has been a huge issue for the US since the global financial crisis. We're also seeing more fiscal coordination across the regions around the green transition in particular, which itself could provide innovation and productivity growth going forward. So there are these avenues to get to something that looks better than where we were even before this pandemic hit. But we shouldn't lose sight of the fact that there were headwinds there before the pandemic. They are still there now. And I'm thinking in particular about demographics, deglobalization, and of course, higher debt levels, all of which will weigh on productivity growth.
It seems to me, Jan, there's a mixture of macro and micro here at work. You've done a lot of research at the individual company level. As Catherine has been saying, there's also a question of the macro policies. Where in those countries that you have surveyed, could you wrap up, we're coming to the end of the broadcast, could you wrap up and say, where have you seen in the countries that you've surveyed and in the sectors you've looked at, where have you seen absolutely exemplary practice at the micro level that you would recommend? And where have you seen sectors or countries lagging behind where you would make a recommendation, you can do this better?
Yeah, as mentioned, I actually wouldn't say that there is a clear disparity on the micro level. There have been really stunning examples across all countries and across all sectors, from, say, in the UK, the National Health Service picking up from 15 to 85% share of online consultations, and telemedicine can be way more productive, to, of course, everything that big and also up-and-coming tech has done in the US, from enabling homework technologies to ramping up massively on cloud services and so on. So you can actually see good examples, good practices across the board. So I would also much more see the question mark and the action needed on the macro front. So if we have discussed, for instance, misallocation of resources, usually you're talking about labor and capital. I would say that is a little bit of maybe even an outdated approach, because you want the largest and most productive firms to grow share, and they are not labor and capital constrained currently. They're talent and market constrained. So you need to first and foremost make sure the markets grow to keep a high pressure economy, so that the largest firms can outgrow, can be more profitable, can attract the best talent. And that is the area where structurally, actually, the US is performing worst. So biggest declines in labor share of income, biggest increases in inequality, all structural, largest superstar effects, all forces that dampen median incomes and consumption, but where in terms of the macro policies, particularly on the fiscal side, they're just making up for it. And in Europe, there's many more question marks.
Okay, we're going to round off now with just a final set of questions. Jan, you'll have the last word, but a very simple question and short answers, please, starting off with you, Gilbert. Will the gap that we see between the United States and Europe in terms of demand with this huge Biden plan, will this gap prove to be unbridgeable? Will we be living with this gap between the United States and Europe for a large number of years? And will the next generation fund of the EU be a game changer? A very quick answer, please, Gilbert.
Everything will depend on household behavior. We know that the saving of households is during this crisis has increased by large amounts, and the behavior of a household to spend this money or to keep this saving will be the key answer to the question concerning demand in Europe, in France, as in Germany, and in all European countries.
Catherine, your answer, please.
Europe will get there in the end in terms of having the right set of macroeconomic policies, including fiscal. It will take time. I think we'll need to see some quick wins, particularly in Italy, around early disbursements of this next generation EU to really build up a constituency across Europe for this kind of centralized fund. But I'm cautiously optimistic. I think they will get there in the end. But of course, there's a risk that delay could be hardwired in terms of a permanent gap, and that does concern
me. Jan, final words from you on that question?
So I think for the short term, there will be a gap. For the mid to longer term, it's less clear in aging demographics where populations want to save. What really matters is getting investment up. And that is a matter of business optimism, a matter of sustainability regulation, and to an extent also of zoning and housing rules to address our affordable housing investment needs. And let's see what the future has in store for us.
Thank you all very much for taking us through the main elements of Jan Mischke's report on can productivity and growth catch up after the end of the pandemic. It's a long and very meaty report with lots of graphs, lots of charts, lots of questions, lots of bullet points. I do recommend you all to read the report. Thank you very much indeed, Gilbert Sett from the Banque de France, Catherine Nice from PGIM, and Jan Mischke, the author of the report from the McKinsey Global Institute. Thank you for tuning in. Read the report, and let's have you all back in about 6 months to see whether your findings still seem to be plausible in 6 months as they do now. So thank you all very much indeed for taking part. I'm going to say goodbye from OMFIF in London. Goodbye and have a good day, everybody.